Hey everyone, thanks for joining us for this next segment of Financial Forum Education with New Life CFO. And today's topic is going to be tax planning in an uncertain tax world. And thank God these people are here because I don't even do my own taxes, much less talk to people about taxes. But we all know that this legislation is on the horizon. So we know that legislative and tax changes are going to happen, but we only have 3 months left to the year. So we really want to get with these experts and talk about what's going to happen, what are your insights about the new legislation, what decisions do businesses need to be thinking about in the next 3 months, what decisions do individuals need to be thinking about in the next 3 months, and then let's flip that into what's going to happen next year and kind of do longer term tax planning. And really given the idea of how do we help these people make better decisions, whether or not they use the input, we can't determine, but the best thing is just to get the information out there as soon as possible. Now today we're really lucky that we have two great firms that are represented here. We have Howard CPAs with Sarah Hancock, and then with Lane Gorman and Trubitt, we have John Wellington and David Hill. Now, with that said, I'd like y'all to give a little background about you individually, how long you've been doing CPAing and taxing and all that other kind of fun stuff. And after that, we'll start jumping into the conversational part. Sarah, you want to kick us off, ladies first?
Sure. I'm with Howard LLP. I've been doing this stuff for 20 some odd years. So seen a lot of different things. I've been with Howard for a little over 7 years. Love being there. We try to be that advocate for our clients and try to be that tax planner and kind of do the planning and the restructuring or whatever you need to make your business more successful. We have a lot of high net wealth, so this new bill is gonna. I've gotten a lot of questions on that so far from my clients going, wait, what? So trying to be proactive there for them.
Very nice. John, how about you?
Sure. My name is John Wellington with Lane Gorman Trubitt. I am actually an attorney and not a CPA, but I have been practicing in the tax arena my whole career, which is now 20 plus years. I primarily focus on state and local tax matters, such as state income taxes, sales tax, property tax, all the kind of other taxes. But as an attorney, I also spend a lot of time looking at legislation and trying to, interpret that for our firm and our clients as well. So I we'll be able to speak on those topics as well.
That's awesome, because one of the topics we're going to go into is with the new economy and all these remote workers, what does that do to people's, is that affecting their nexus and things they need to be aware of?
Oh, yes.
All right, Mr. David, how about you?
So, David Hill, I'm a principal here in the tax department at Lane Gorman Trubitt. Been here a little over 3 years, have about 15 years in public accounting experience altogether. I would say the main thing that we focus on at firm is closely held businesses and things with other high net worth individuals. Have a wide variety of niches, but the main thing being the closely held business is our specialty.
Very nice. So some of y'all may be wondering, why are these people here? Well, it's primarily because we have a know, like, and trust relationship with these two firms. But most importantly, both these firms serve the marketplace of most of your clients are $100 million and less. So this is intended to serve the entrepreneurial marketplace, mid-market clients throughout the DFW area. So we thought this would be a perfect fit. So now we get to kick off into the fun stuff and actually talk about taxes, which, thank God, that's why you're here. So if y'all would, tell me about your perceptions of the new tax laws that are coming and the real either things that are shock and awe to you or things that you think are quintessentially important for people to understand or to be aware of as they're going into it and how it's going to affect them.
Sure.
We'll start with you this time.
So I think the main point to take away right now is every proposal plan out there has taxes going up. There's in no way, shape, or form anything out there that's decreasing taxes right now. So to keep that in mind, and when you're making decisions and timing and planning and also entity structure, one of the other big changes right now is what they're looking to do to the estate tax. So if you have any ownership planning or transition or gifting you were thinking about doing, you really need to kind of get on that now, because they're trying to
very important.
Yeah, structurally change the way that works. I think that's one of the things that it's not a more publicized part of the proposals out there, but it will affect a lot of people, so they need to look into that part.
Because we hear so much about the rates as a first thing, but
Right.
for a lot of the audience that we're talking to, either establishing trusts or in managing the structure of their trust or what transactions, that's going to be a
Right.
really important topic. We have that later on as we get into the individuals, if that's an appropriate deal, but I really appreciate you bringing that up because you don't hear about that side of the law at all.
Right.
John, how about you?
Yeah, I think I'd echo what David said. From a big picture perspective, I think, again, obviously taxes are going up, but there have been some analyses already done on kind of the proposals that are out there now from the Ways and Means Committee, which are going to be the ones that we're going to talk about and kind of the only ones that we have to go on as of right now. Again, everything's subject to change. But, one of Biden's promises was that taxes wouldn't go up on people earning under $400,000. And I think some of these analyses I've seen said that that's pretty much accurate, that most families, under that amount should not see any raises. But of course, there's arguments that to the extent corporate tax rates go up, that will, ultimately hurt the workers there and things of that nature. So in that way, it could impact people earning less than $400,000, or I think it's $450,000 for married taxpayers. But at least in that regard, you can take some comfort that intent seems to be borne out by the proposed legislation so far.
Sounds like good news, but
now, yeah, if you're over $400,000 and then there's some critical rates, additional taxes that are on incomes over $5 million, then you're in a whole different ballgame, and they're the ones who are really going to bear the brunt of these increases and these changes.
well, that's unfortunate. But if you're at $5 million and above, you're already in a different ballgame.
Well,
That's a good point.
Sarah, how about you? What are your big ahas?
I think the increase in the tax rates for just about most of my clients, so that's kind of my main question. What are the new rates? How's this all going to impact me? When I look at my client base, those people over the 400, 500,000, that's probably 95% of my client base. So that is important to them. But looking at from the business perspective, I'm also getting those questions about they're making a lot of changes to benefits for businesses or not. One of them is they're proposing something where you can change from an S corp to a partnership without a tax impact. Things like that, where we can go back in and look at the business and say, hey, maybe this is our opportunity to do some things and meet some business goals that you guys have and do some structure planning. So I'm looking forward to kind of that stuff and seeing what comes out of that and maybe being able to do some things there and advise some clients that way.
So with the 400,000 kind of threshold, and I think it's affirming that you say that it looks like that's all going to be held. Will it be compensation strategies that come about deferred comp versus immediately bonusable comp that people need to be thinking about as they're looking towards the future to, one of the things that runs through my head is, can I transition in administration? Either through 1031, like-kind exchanges, or through compensation things. So something to think about as we get down to the individual, or if you're an owner of a business, you have a little bit more availability to be creative in how you pay yourself. So those are really important topics as we get there. Were there any surprises for y'all? We hear a lot about we're going to close the loopholes. Gosh dog it, we got to close these loopholes. But there's a lot of loopholes that we hear about that weren't closed, to my understanding, like carried interest. And were there other things that were surprises to you about what was or wasn't done in this law?
Well, one thing that you'll at least see a lot in the news is about the SALT cap, which limits the amount of deduction that an individual could take for federal tax purposes on their state taxes that they paid. So typically that most directly impacts taxpayers in high tax states, New York, California, and the like, etc. In Texas there is no personal income tax, but that's a very costly benefit to give. So that benefit was capped at $10,000, the deduction under the Tax Cuts Jobs Act, and so there's a lot of political will or folks wanting those caps either be increased or removed, but there's nothing one way or the other in this legislation, either for pro or con. So as it stands right now, people are hoping to either see that cap raised or eliminated or are going to be disappointed. But certainly on the political landscape, you see a lot of people saying they're not going to vote for this thing unless that cap is somehow improved upon for taxpayers. So we'll just have to see where that goes. But probably the biggest topic that was talked about was this step up in basis on when someone dies. Traditionally, whoever receives that property gets a step up in basis in that property. So if and when they sell that property, they would not be taxed on that appreciated gain while it was owned by the decedent. So Biden was making a big push for that, and that provision was in a lot of his proposals or discussion coming into kind of the nitty-gritty here. But right now, there is no legislation that's going to do that. So that's essentially been removed as things stand today.
Really?
Yes.
Wow, that's surprising.
Yeah,
because that was a very hot topic for
yes,
on estate planning and everything else.
Exactly.
Anything from your perspective that you thought was a surprise of not done or done?
Yeah, so I thought the biggest surprise, as I saw in the latest proposal, is applying the net investment income tax to trader business income.
Okay, you just went way over my head. So Can you reel that back a little bit?
Sure.
What that means?
What it was, it's a 3.8% tax for higher earners on investment income in the past. Part of when Obama was in office, those were part of the taxes that came in.
Yep.
But it has always been for investment income, dividends, interest, things of that nature.
Okay.
And now they're talking about applying. So that would basically, whatever your tax rate is, tack another, 3.8 or whatever they land on percent on top of that. I just was not expecting for that to be as broadly applied as it is, at least now in the proposal. I'm sure it'll change by the time it
and that would also only be for taxpayers above a certain higher threshold.
Oh, okay. Good, because you're scaring me there.
Yeah.
Yeah.
But you did a great job of re-explaining that, so thank you very much.
No problem.
So I'm the person of the lay person, even though I am a CPA. So if you use terms that I don't understand, I assume nobody else does. I know that y'all know them very well. So let's kind of reel in and talk about the specific impacts on business owners for this year's action that they need to consider or take before the end of the year to try and ameliorate or protect themselves against the new law. So what would be your number 1, 2, and 3 tactics that you think that they need to be thinking about, reaching out to tax experts like yourself to really vet these opportunities? So Sarah, what would that be for you?
I think planning is a big part of it, and making them kind of understand what's going to happen next year. There's things we just can't avoid, right? The tax rates are going up. It's just being able to plan for that, I think, is a big part of that. Doing that piece of it. One of my clients asked me about were there any changes to depreciation and that ability to expense their equipment and stuff, and there wasn't, and that was one thing that I was surprised. There's usually something always about depreciation in a new tax bill. It's always changing, and there wasn't anything in there. So that was several questions from clients I got on that, and that's not there. So
Section 179 stays in place?
It stays, as it is now. So
that's a great opportunity to start looking into 22 about purchases and pull those bad boys in now.
Right, and help mitigate some of the increases maybe. So
very nice.
Stuff. So that's a couple things. And then just the restructuring, I think, is a big thing as well. Just, if they've been looking for that, maybe that's the time to revisit it and get something done by the end of the year, if possible.
Entity restructuring?
Mm-hmm.
Okay, we're going to come back to that because I really want to dive into that, and especially the timing. Because if there's big benefits about entity restructuring, then that could be a whole, when you get, of course, we have the attorney here, but when you get into the legal aspects, there's a whole lot of heavy lifting that has to take place. So if that's one of your recommended strategies, that's probably something that people need to reach out on as soon as possible, just because there's a lot of heavy lifting to take place. John, what would be your thoughts since you're the legal guru here?
Well, as any good lawyer would tell you, it depends. And so there's really
that sounds like my professor from grad school.
So, it's hard to say right now, like with respect to capital gains, the natural thought would be to, sell things now while rates are lower. But under the proposed legislation, these increased capital gains rates are effective as of when this proposal was made, which was September 13th, or, point being that if it passes as is, then there would be no benefit to selling this year as opposed to next year because those rates would already be in effect. Now, of course, if that that's a very kind of strange thing in the tax world to have something, become effective during a tax year, and especially with no advance notice to taxpayers. So to the extent that ends up being pulled from it, then of course, and rates go up in the future. Right now, the rate's 20%. They're talking about raising to 25%. So if in fact you can take advantage of that between now and the end of the year, that would certainly be something to consider with respect to individuals selling assets.
So I'm going to change that to a personal question. Let's say that you have some collector cars that you've owned since you were driving cars in our teens and everything else, and they're worth a boatload right now. Would you be considering selling those before the end of the year?
Well, I could only imagine that the tax driver would be less important than the reality of that marketplace and how things are doing. I know there's a lot of markets that are kind of in a different world right now with COVID, and certain things are multiples skyrocketing, things like that. So I would always caution, don't let the tax tail wag the dog for a 5% difference, right? If you think something's going to be worth 5% more, whatever time period, that would be more important, or at least as important. But again, it really just depends on if this thing is going to be effective as of essentially it's effective now. Basically, if this passes as is, then there's no benefit. Yeah, exactly.
But that's great advice. Let's keep this in context. If it's a 5-point difference, is that what you said?
Yes.
Yeah. So if your asset's going to continue to grow beyond 5 points, it's like, okay, is that really the best economic decision?
And in that situation, can I just throw this out there? There is a separate capital gains rate on collections. If you're looking at specifically your
that
question.
Wasn't a specific question for me. I don't have any antique cars. I'm looking to dump.
So,
but no, that's good.
Do I need to plan for that?
Yeah, Sarah does my taxes, so she knows all too well what I do or do not have. David, how about for you?
So I would say this year is a little bit different than a typical strategy year, to where you kind of want to do the opposite of what you normally do, where you actually pull income into the current year and defer expense. So typically we're always, the tax plan is defer, keep as much capital in the business as you can.
Right.
But in this year, it makes more sense if you can. I mean, as John said, you made a really good point. It has to make economic sense to do this.
Right.
Doing something purely for tax purposes is rarely a good idea, unless it has good economic benefit behind it. But yeah, I would look to that to see what you can do for the timing of events.
Very nice. Very nice. I like that. Okay. Let's kind of pivot a little bit more into, so we talked about that 179 was going to stay, and that's huge, because that's a big lever for a lot of small businesses, whether it's semi-personal or productive assets and everything else like that. So that's a huge benefit. Did they change any caps related to 179 or any ability to utilize that?
I didn't see anything like that in the legislation or proposed legislation.
Neither.
And just so I don't really jack it up, would one of y'all like to explain 179 to everybody else that's out there? Most entrepreneurs are pretty familiar with it because they use the dog out of it, but just in case, how would y'all best describe 179?
So I would say and most business owners love it because they can buy something and immediately expense it.
Right.
So that's, the cash is gone, so is the expense.
And it's a great benefit. So, if you're looking at things that you're going to be buying in anytime in 2022, heavily suggest looking at maybe accelerating that purchase into this year. As I think through that, though, with 179, would that be one thing that if it's going to stay in place,
you'd wait till next year?
Yeah, you wait until next year. So I had that completely wrong, which is why John was looking at me like I'm the biggest idiot in the world. So those things you push into next year and avoid that typical thing of I want to accelerate those into December. Okay. Right. So probably what's going through my head is if it went away, then I want to do as much of it as fast as possible. I'm so glad y'all are here. That's why we have experts around here. Let's dive a little bit more into entity structure and where that has nuances either for this year, because y'all said that was potentially a very urgent matter, or into next year and beyond.
I don't mind jumping in there. I think for timing perspective, not to cram it down, I guess my thought was I do have clients that are looking already, should they change structure? Those would be the kind of people that would need to talk about it right now and just say, hey, now if we've already started that conversation, do we need to go ahead and flip the switch by the end of the year? There are some things in the proposed legislation, like I mentioned before, that S Corp to partnership conversion opportunity that's in there, that maybe that's something someone wants to think about, depending on what kind of entity and what the shareholders would benefit from that. I just think it's always important as you go through the life of your business that you always ask that question. Are we going to be better as this type of entity versus where we are now?
And it opens the door to being able to change, because sometimes there's restrictions about when you can you change, or how often you can change.
And the taxability of it. That's the big thing. Am I going to have to pay for this change? And
yeah, that's
what people don't want to do, right?
So thoughts on that, John?
I don't know if I have too many other great thoughts, but I would note that under the proposed legislation, the corporate rates are going to be progressive, which means that there's going to be actually a lower rate than there is now for companies that earn under $400,000. There's that magic number again. The rate will be the same as it is now, 21% for a corporation earning up to $5 million. And then it'll be a new rate of 26.5% above that. So people who, back at the Tax Cuts Jobs Act, some people actually made corporate changes or, structural changes to take advantage of various provisions. And so again, it may depend where you fall in that spectrum to whether making one of these plans or where you're going to land in the future, even probably more importantly, that should also help inform your thought process.
Very nice. Anything to add?
Yeah, I'd say anytime you look at any structure, it's imperative that you consider your short-term and your long-term goals.
Okay.
Because it's also a very kind of personal to the business, how it works, how your money moves. You really need to look at a lot of factors before you consider switching structures. That's why it's good, you run a lot of simulations, and a really good point on the taxability to actually make it happen. Because a lot of times that could be a real driver of the decision.
Yep.
That's all I would add, is just really make sure you have all your goals in mind.
Okay. I'm going to go back to one topic that we just briefly touched on. As an owner, I'm pretty flexible on how I pay myself. Given this $400,000 kind of hurdle, is there going to be tactics to be considered about deferred compensation versus bonusable, distributed, or 1099 kind of compensation? How would that work? Is that something that people need to start exploring?
Anyway.
Well, this sounds like it's going to be a good topic just from the expressions.
Well, I would think it's a little premature to really be able to comment with any great authority. But again, talking about these provisions, and in the past, or under the Tax Cuts Jobs Act, they created this deduction for business owners for a qualified business deduction, which is pretty substantial. And so I would think that's going to be capped for certain taxpayers, I think above $5 million, again, under the new rules. So to the extent that, someone falls in that bucket, it might be worth understanding kind of, you can't just look at just a rate. You got to look at how all these provisions are going to work together. And, again, that would inform your decision on how best to proceed. But just looking at it from any narrow perspective is going to, is not going to be the best approach. You're going to have to look at all these provisions. And until they're final, it's really hard to say. They could just remove something over here that would change the answer over there. And so
right.
It's really just, just speculation at this point.
Yeah, so with all that fluidity in this conversation, it just makes me think, gosh, I need to make sure that I have my appointment set with Sarah for X day to make sure that I'm already on her calendar to start vetting through this stuff, maybe in December and then again in January. And if you don't have a tax CPA, get one. Here's 3 you might want to talk to. Tax attorney.
Sure.
So are there any changes to the limitations people can be with their sets or keyhoes or anything else like that y'all have heard about that people need to be thinking about? Because, again, we're coming up to that point in time where people start determining how much do I put into my set, my keyhole, et cetera.
There are some limits with respect to taxpayers who have significant accounts. I think, like $10 million significant, that they want to limit the ability of, taxpayers to take advantage of those at that kind of level. There's various other contribution limits that are changing, and some requirements to withdraw increased amounts from your retirement accounts. But outside of those kind of changes, I'm not really sure there's a great answer to that.
Okay.
There was a couple of changes proposed about Roth IRAs, going between Roth and ordinary IRAs. Some limitations put in there now. Again, closing some loopholes.
Yeah, like that big one that we heard about earlier in the year.
Yeah. So, if that's important to you, that's something to look at too.
Yeah, because that sounded very interesting when it hit the news about what I just contribute a big lump into this IRA, flip it over to that one, and I'm all good forever.
The non-deductible.
Yeah,
Right.
I thought that was an interesting trick.
Yeah.
I've heard that they wanted to eliminate that, but I didn't actually read anything on it yet. Sure, it was in there.
It was in the Ways and Means
It wasn't okay.
thing they put out. Yeah, just again proposed. Who knows if it'll pass?
Yeah, it's pretty murky waters, but we need to start talking about it now because God knows the way Congress moves, it'll probably get voted on the 30th of December. Our ability to plan at that point is done. One of the last things that kind of affects the business has to do with how people work so very differently. And this is a great segue to go from business to individuals as well. So we have so many remote workers, and we hear about the great resignation that's on the horizon, which may create more remote workers. So how does remote workers change people's aspects or tax possible consequences for a business? And then perhaps for the individual I now have a home office, and that used to be the biggest red flag in the world. Like, don't wave that thing in front of the IRS bull. But maybe that's changed with all these new things. So can y'all help us understand that?
Yeah, I think the home office deduction was eliminated under the Tax Cuts Jobs Act. 'Cause I think I tried looking at that for myself last year.
That's why I don't do this and they do.
But yeah, your point is well taken. But from the individual perspective, let's say you're a Texan living here where there is no personal income tax, and then you have to go, let's say, take care of a relative in Oklahoma because they have COVID, and you're there for, a substantial period of time. Generally speaking, you are taxed on your wages where they're earned. So in theory, that person should be paying Oklahoma personal income tax at the end of the year, and further, their employer would have withholding requirements and unemployment insurance requirements with the state. Now, a lot of states had sort of safe harbors during COVID. Not that we're out of COVID, but a lot of the benefits, they said, it's okay if you're here for COVID. A lot of those that were implemented now, a year and a half ago, have expired or are close to expiring, or, it's kind of like you need a really good doctor's note to qualify for these exemptions. But so those types of, those safe harbors are basically gone. So from an employer perspective, you may now have folks in states where you've never done any of these things, and you're not sure when your requirements, compliance responsibilities started. And of course, you might not be sure about all of them. So that's something employers definitely need to start making sure they know where their employees are. And then that also raises a whole host of other issues for companies. For example, for income tax purposes, do I now have to file an income tax return in that state because I have an employee there? And then when you go to figure out, what percent of my income it should be apportioned to that state, do I include that employee's wages as Oklahoma wages in this example as opposed to Texas? That same company may be now be subject to sales tax in the state that they weren't previously subject to sales tax for because they have an employee there. So there's a whole host of issues that could rise up that even if, again, there was these safe harbors, it might have been temporarily okay because of, these things are kind of becoming more permanent, or at least
Right.
they are for certain individuals, or maybe they're not. Maybe they're in Oklahoma today and they're in, another state tomorrow. So it definitely adds a whole other layer of complications all across the state tax spectrum.
So if I'm a remote worker, and we had one client where one of their people just says, I've worked remotely this whole last year. Do you mind if I go work remotely from Colorado? So as an individual, I probably need to be thinking about where am I going to work remote? There's lots of great locations, but which ones are high tax locations? Which ones are low tax locations?
Yeah, from the worker perspective, to the extent you have that flexibility, then yeah, you may be facing all sorts of tax complications that you didn't have in your home state, or you just got comfortable that this is the way it was done, where I am. And, every state is different. Every region of the country is different. Some regions are kind of, like in the Northeast, it's kind of like they all have these reciprocal agreements where they're like, okay, we don't, we know people are transferring or traveling around. The state's a lot smaller, so it all depends. Like I said earlier,
Very
but you
nice.
definitely want to make sure you check those boxes as an employer or an employee, because the states are hungry for this revenue, and that obviously they're aware of these issues as well.
Yeah, a long time ago, I worked up in New York for PepsiCo. Lived in Connecticut,
Purchase.
worked in Purchase, great, beautiful place, and sometimes went into the city. And it was like, oh my gosh, I kind of put my foot into the shallow end by going into the state, and I went into the deep end if I went into the city. So I tried not to ever work in the city.
Yeah, lots of other taxes in the city.
Yeah.
Yeah, and
So, go
I was
ahead.
just going to add to that. Some of the states and cities up in the Northeast primarily are having lawsuits with each other. It used to be that people did that commuting from one state to another, and they worked in one state. That's where they were taxed. And now they're working remote, and now these cities and states are coming back saying, hey, we want this tax. And they're like, well, we didn't go there. They're like, no, you still have to pay this tax. And I know there's some lawsuits related to that. So it'd be interesting to see how that comes out. But
Yeah.
Well, you could have two states that disagree, and two states could say you owe them tax, and then not ideal, but obviously.
Okay,
that
so
can happen.
more migration out of the high tech. So, how about for employers? I had that same client that I just talked about that had an employee go to Colorado. Well, they had another one that went to California. And now we're facing, and we didn't think through it, and now they're facing the fact of, oh my gosh, we may have created Nexus in California. And I'm not trying to speak bad of California, but it's probably one of the most heavily regulated regulatory tax states that I think we have.
Yeah, I mean, as I mentioned earlier, that company can now be exposed to whether it's income tax or sales tax or unemployment requirements, and to the extent that that employee does in fact is kind of registered in their system as an employee for payroll purposes or withholding or unemployment. Well, they're also they know about you for every other reason too now, right? You're going to get on their mailing list, and
Oh,
you
geez.
should expect to receive a notice saying, you may have an excuse why you haven't filed an income tax return, but we'd like to hear it. So, once you put yourself on the radar screen, that also adds, even if you're right, you may still have to prove it to the state to get them off your back.
Okay, so I need to instantly dash back out to that client and says, we need to find a migratory path for this employee. Because we're not doing a whole lot of business there, and we certainly don't want to be on California's radar screen. So as we move down to the individual, is the individual treated differently on cap gains than all other cap gains, or is it just, I love the conversation about really look at the economics of your assets and the potential growth of the assets. It's not a knee-jerk reaction, and I appreciate y'all saying that because I tended to be more knee-jerk than thoughtful, especially on taxes. Any other situations that you really think the individual needs to look at their individual situation?
in relation to the cap gains?
Or other tax caveats, credits that are being proposed. And this could be with the people that aren't in the high net worth area as far as those additional credits and how they may start applying, because there's a whole bunch of family-oriented credits that have been talked about. I just don't know what's in the bill.
I didn't see a lot of those credits. There were some worker opportunity credits that were bannered around for businesses. For individuals, again, I think most of the focus was on people over that 400,000 to 500,000 AGI range.
Okay.
And so that's where I would focus a lot more of my, when I'm talking to my clients,
Yeah.
looking at those clients first, probably. And then the business, I deal with a lot of pass-throughs, so S-corps, partnerships, do a lot of real estate. So that kind of stuff coming into an individual's return, how that impacts them. So some of the stuff at the business level, changes may impact my individual. So looking at some of those things.
Okay.
That it's, I guess, just the planning for those people over 400,000. What's their new tax rate? What's their ability to make contributions for retirement and stuff like that.
So one of the things that we hear about a lot, and I'll start with you on this one, David, is there's so much, the Green New Deal, clean energy, and things like that nature Are there any credits that have been proposed as far as helping individuals or companies invest in clean energy? We hear about the thing with Tesla of, you get some car credit if you go buy an electric car. Are there other things like solar panels or installing wind or whatever that might be considered in this law?
So I think from that perspective, I would expect to see more of that in the future, like new credits coming out. Because currently you have building credits, which is the main one we see utilized with our construction companies.
Okay.
Which they get a pretty significant benefit for building houses that meet certain requirements. So it makes it worthwhile to do it, because to incur that cost for the credit. But I would expect to see more of that as the big push, especially as part of this moving towards electric vehicles and federal targets by, I can't recall the day, was it 2030, or some of the states are doing that as well.
Yeah.
I think. So I would expect to see even more at the state level for those states that are taxable to have those credits to help, because they still have all these gas vehicles on the road they gotta get off the road if they want to really replace the fleet. So I would really think at a state level there'd be a whole lot more of the energy-related credits coming across. So I don't know if you
that makes sense. I mean, you kind of look at if there's more electric demand and the grid is already under stress, solar panels, other things come into, because electric cars are great, but they put more stress on the grid. So those type things. So I just didn't know if it was already in the bill or not. But I agree with you. I think we're going to see more and more of that over the next 2, 5, 10 years. Mm-hmm. Some transition on there because it's hard to build more and more power plants.
Yeah, I think a lot of that will come from, a lot of this money is being raised, right, to pay for other things, including infrastructure and things of that nature. So I think there aren't a lot of revenue raisers in the proposed legislation related to renewables or anything like that, or carbon taxes, anything along those lines. I think that this is just kind of separate from that, primarily. And then, of course, the infrastructure bill, the goal is to build a lot of things with renewable or less energy use in the future. So you might see some things there that are, if they're not tax credits, they could be other ways to encourage such behavior.
Yeah, I think one thing I saw too was some of the people were surprised that there wasn't more in the proposed legislation regarding limitations on depletion and stuff in oil and gas, because that's always been a big thing for them. And so I didn't see anything in there limiting that anymore, which I thought was going to be something that they would have here. Speaking to that, green thought that they want to have.
That's good.
Everything electric,
especially in this
state. If you're in the oil and gas business, it's great. But for those people that are against that or don't,
There's a whole lot of people out in West Texas that just became very happy.
Yes.
So 2 last topics, one still on the individual, then we're going to flip over into some of the just finer points on estate planning and the use of trust to possibly do asset or income protection. A conversation I had with one of my clients was possibly using 1031 on a like-kind exchanges to the way that they described it as, can we skip an administration and park some profits elsewhere until the codes become a little bit more favorable? Is 1031 under attack in this bill? Are those type of tactics even something you'd recommend?
1031's been bantered about. There's been several articles that I've read. Again, I work a lot with real estate, so my real estate guys are like, hey, is this going away, whatever? Because they took it away to where all you could exchange was real property, and so if you take that away, a lot of my real estate guys are just in total panic. But especially the small businesses, and I think that's where this administration's getting the pushback is, the farmers, the small businesses.
Right.
This helps them financially to be able to do these exchanges. If you take that away, there's a lot of people that are going to be affected by this, and the repercussions would be huge if you took that away. So I don't think if they try to push it through that it will pass. Even that's been on both sides that they don't agree that that's a good position. They did come back and say that it may be that they cap the amount that you defer, and that may be what we see. But as far as getting rid of them for small businesses, I think that probably won't happen.
So for the ignorant many, 1031 like-kind exchanges, correct?
Yes.
So I'm swapping an asset that's appreciated for another asset that is appreciated, but I don't have to recognize the gain or pay taxes on that appreciated value, correct?
Correct.
For the most part.
For the most part.
So you used to be able to do that with your cars, but now you can't, only with real property.
Okay. Good. I almost got a solid yes on a tax question. So let's shift over to estates and how individuals or companies can use estates to help protect the assets or the appreciated value of their assets. Do you do a lot of that?
Yeah, we have pretty big estate practice here.
Oh, okay. So you're the perfect guy to start off this conversation.
Yeah, so one of the most interesting things in the proposal, we mentioned it earlier, is they talked, well, there's two big changes, is they talked about making grantor trusts includable in your estate. And for a long time, what grantor trusts really allow you to do is basically still own your business and you pay the taxes related to the business. But then when you pass away, it's out of your estate. There's no estate tax on that. And it's been a strategy used for several years. And they come out and said, well, if you do a grantor what's been a proposal trust after this date, it will be included in your taxable estate, which would be a massive change. It's one thing to have the exemption drop to, I believe it was over, is it $5 million some change, or was it roughly in half? But this kind of changes the whole way you go about planning. And the other big change is they're looking at how discounts. So traditionally, when you gift a business, buy or sell, in an estate terminology, you have a discount for lack of marketability or lack of control.
Right.
So
pretty significant discount.
Right, significant. They've come out and said certain items we don't think should be able to be discounted, such as the specific items I saw was cash, real estate, stocks, and bonds. So yeah, and the language was a little loose around it. So I was reading between the lines. It looked like you could still potentially get the discount on the business asset, but not on the cash or real estate portion is how I read it. But that would be another big shift in how when you're planning, if you're expecting to give this asset, X value may not work. You might use more than your exemption and have the taxable event that you weren't expecting. So it's very important to be kind of aware of all the implications.
And manage that closely with somebody like y'all.
Yeah.
Because that's not a tricky thing that the layperson needs to be jumping into.
Right, yeah,
there's a lot of bear traps.
Yeah.
So one of those things, if you do it once and you do it wrong, you got a problem for a long time. So should a business owner consider putting their business into a trust?
Yeah, it makes sense. It goes back to the entity structuring is so specific to your business and your ultimate goals. Because one thing is if you plan on passing your business on to a family member, an heir, or do you want to sell it to other owners, employees, all these decisions need to go into making the right one for you. The trust situation works a whole lot better for more of like a familial type transfer.
Okay.
But there's, like I said, it's very specific to the business. Need to kind of walk through, like I said, all the traps. Make sure you're doing the right thing.
Nice. So, Sarah, we won't have to meet on this because neither one of my kids want to finance an account.
Okay.
So we're safe
Mark
there.
it off that checklist.
That's right. What other considerations as far as trust and asset management do y'all think are important to make sure people are talking to y'all about?
Well, I think, again, just with all the legislation being unclear and, everyone's facts being so specific, it's hard to speak too specifically about anything. But even when the estate exemption goes, even if it gets cut in half from what was 10, now it's like 11 because of inflation, gets cut in half to 5, that's still, 10 for a married couple, which is, a significant amount of money that covers, a good portion of people. So a lot of people in their estate planning, tax is important, but it's also just as important to make sure and all the other reasons why you do estate planning, so that, you don't want your kids to have too much too soon, or you don't want creditors to be able to get something, and all those sorts of decisions. So with the $10 million exemption, it's still fairly significant. It's very significant to me, at least. So I think, even in the estate planning world, there's usually a lot of other reasons that are going to be more important than, all the minutia about minimizing estate taxes. Then, of course, you still have income tax planning, and you have all the other possible things to be concerned about.
John, I'm going to kind of lean in on you because you're in this unique position of being an attorney that works at a CPA firm. So when people are estate planning curious, should they start out at the CPA firm or should they start out at a law firm?
Well, ideally, I think you'd want to talk to both, right? Certainly, a CPA firm, they're going to have a certain kind of knowledge.
It's okay if you're self-serving here, right?
Well, I think the point is that you want someone who just knows what you want, right?
Right.
Who can, I think you get good advice from different people, but you got to make sure that you're telling them, what it is that you are trying to achieve in your goals. And ultimately, any kind of, if it involves any actual formation of entities or anything, any CPA firm's going to get a law firm involved. And if it involves, if you start with the law firm, they're going to need a CPA to also do things. So it's a collaborative effort, I would think, certainly. But nonetheless, you should reach out to, I'd say both, or, again, someone who you trust to give you good advice and kind of knows what your goals are.
And trust in financial stuff is so important. It's the reason that we wanted to start with y'all. Is between our firm and y'all's, there's already a know, like, and trust factor, which makes it very easy to have these kinds of conversations. And before we wrap up, is there anything else that I know there's a ton that I missed, so please don't highlight my ignorance. But is there anything else that you want to specifically highlight before we kind of conclude our conversation today?
I guess I would say all of this is proposed. None of it's set in stone yet, so you can plan. And what I typically do with clients is we run it under the old scenario and the potential new scenario. Let's look at both pieces and plan for what, if this all does happen and the law comes into place. I think the planning is just such a key part of that relationship with your accountant, and doing that and just setting those goals. And you mentioned the businesses and retirement and keeping it in the family. Is that your goal as a business owner, or is it that you're going to sell it to key employees or whatever? So knowing what business goals are key to you too helps in the planning process. So I just think all that, and having that discussion with your attorney and your CPA team is just so important. And I'd love to be that advocate for my clients and say, hey, let's talk through this. We may not be able to change the law, but let's plan for it. Let's try to make the best situation out of it that we can.
Very nice. So get with your CPA, or if you don't have one, find one. Plan early and often, and it's okay to have two plans on the shelf ready for whether the law changes before or it doesn't. So I think that's great input. Anything else?
No, I think she said it very nicely.
Well, I want to thank y'all for your time today, because I know all of us are in an hours game. So I've consumed some of y'all's hours, but y'all had great input. Thank you very much for taking the time to do this, and look forward to possibly doing this again next year.
Wonderful. Our pleasure.
No problem.